How many buildings and what's the assets under management right now?
We are currently 50 buildings, ownership and management. It's 10,000 units or just under 10,000 units. We own and operate across 4 states.
Your grandfather was a Holocaust survivor and built this company from nothing. And so now you're moving $500 million away from California, right? Which he built everything in California.
The bank is calling and saying, Jack, you have to pay back your loan. And my grandfather, who's basically goes to the loan officer and says, I can sell these lots. I'm gonna sell these lots. I'm gonna do this, that he's gonna sell these lots. Works on it for another year or two, basically sells it at cost to just pay back the lender. We lost the most money in our company's history the day that ULA passed.
Real quick, before we hop into today's episode, I am so excited to share that we have a sponsor for today's episode, and that is AI for CRE Collective. This is actually a community that Jay Keller and myself started because we were tired of getting left behind with AI. We're nerds about it. We love to dive into it. Jake is a master at crafting these prompts, and I'm very heavily invested in trying to be a better broker and use all of the tech and tools that I can to make myself just that much better. And I will tell you this, since starting this community and exploring the workflows and the things, how to use AI effectively in my business, 25 listings at the moment. We're closing 4 or 5 deals a month. It's been incredible. So if you want to learn, if you're in commercial real estate, how to use AI in your business, whether you're a property manager, a broker, an investor, really anyone, we have a huge group, over 400 people in this community. And the website, if you want to go check it out, is AI4CREcollective.com. So appreciate you guys. Now back to the episode. Welcome to the podcast. My name is Taylor Avakian, and I am here with my esteemed guest, Daniel Nagel. Daniel,
Great to be here this morning.
thank you for being here. You are the CIO and CFO of Decron Properties, how many buildings and what's the assets under management right now?
We are currently 50 buildings under management.
Okay.
Ownership and management. It's 10,000 units or just under 10,000 units. We own and operate across 4 states, California, Washington, Arizona, and Texas. And 90% of our portfolio is multifamily. We have approximately 10% in retail and office. We have 1 office building, and we have a few shopping centers. That's our current makeup.
Got it.
But we've been around for 7 decades and have had many pivots.
Yeah, it's pretty incredible, which your grandfather started it. And so your grandfather was a Holocaust survivor and built this company from nothing. And so now you're moving $500 million away from California, right? Which he built everything in California. Can you tell me the story of?
Yeah. My grandfather, Holocaust survivor, most of his family was murdered by the Nazis during World War II. He's a survivor of the camps. And he came to the States in 1947 with basically the shirt on his back and a younger sister who he felt he had to take care of. And his story goes it's an immigrant story. He worked hard. He had to learn English. He started as a import watch, kind of buying wholesale, selling retail.
For watches.
And he would go and he would make sales and he would, learn English and learn how to negotiate. As he, built up his business, he started to feel more established, and he was looking to get married. He was in New York at that time, had cousins here in California who said, I want to set you up with a girl. So he comes out, meets my grandmother, or to-be grandmother, decides right away that she's the one. Basically proposes to her after 3 dates.
That's awesome.
And this is 1955, and
Wow.
They get married, and his business is watches.
Yeah.
And so he says to my grandmother, you got to come back to New York. That's where my business is. So they go back to New York. My grandmother's a California girl at this point. And she hates it. She was so unhappy. So my grandfather calls his cousins and he goes, you set me up with this girl, but she's miserable. She wants to move back to California. What should I do? So they said, move to California. He's like, but what am I going to do in California? They're like, well, can you sell your business? He's like, yeah, I can sell my business. So you're coming to do what we do. Well, what do? We do real estate. And so he sells his business, comes out here in 1956, buys a piece of land in Anaheim, California, because he's excited that there's this small company called Walt Disney that's moving a lot of dirt. He starts building tract homes under the guidance of his cousins, and delivers those tract homes into a recession and cannot sell the homes.
Oh my gosh.
And the bank is calling and saying, Jack, you have to pay back your loan, otherwise we're going to take the property back. And my grandfather, who's been through hell on this earth,
Yeah, geez.
basically goes to the loan officer and says, I can sell these lots. I don't have anything else. You got to let me sell these lots. I'm going to sell these lots. Please give me an extension. Please give me an extension. And they're saying no, and they're saying no, and they're saying no. And he's not taking it. I'm going to sell these lots. I'm going to do this. I'm going to do this for you. And somehow convinces the loan officer that he's going to sell these lots, works on it for another year or two, basically sells it at cost to just pay back the lender, makes not a dollar on the investment, but has his integrity intact because he paid back his lender.
Mm-hmm.
The loan officer comes to him and says, Jack, we don't have a lot of borrowers like you. You have integrity, and for your next deal, you can rely on us to be your lender.
Wow.
And then his next development was in Sylmar. And at that point in time, the economy started to turn. And then that was his break.
Wow.
His break was working hard, doing the right thing. And that lender said, we believe in you. We believe in the way that you do business. Right. And then at that point in time, people had heard, or Jack had sold out of his deal in Anaheim. You know how it is. Like, they don't necessarily know all the details. And they're like, hey, Jack, we'll partner up with you in this Sylmar investment.
So he raised capital.
So at that point in time, and then he went on to be a homebuilder for about 2.5 decades, and he built about 2,000 homes in the San Fernando Valley.
Wow. Okay. So he started out as homes, and I assume these were like spec homes. So he'd buy them to
he would buy land and he would build like tract homes, right? So it started out like he would build, 4, 6, 8, 10, and pretty soon, building larger developments. And it was always ground up construction.
Got it. So he started from dirt.
And it was risky because, it's like development today. You make the decision to build in one market and you deliver in another market. That for sale model was something we eventually moved away from,
Mm-hmm.
but it was the start of his career, and it was the basis for him getting his construction knowledge, and learning the business.
It's so funny because when I started out when I was in high school, like people were asking me, what do you want to do? What do you want to do? And I'm like, I want to be a professional athlete. And they're like, awesome, cool.
You got the height.
Yeah, I know. I appreciate it. And
What sport?
baseball.
Oh, love that. What
Yeah.
position?
I was outfield.
Outfield.
So
Okay.
again, I wanted to do that. Didn't end up working out, but I loved competition. I was always a competitive person. And so when I realized that wasn't going to be my path, I was looking at all the people in my sphere, my friends' dads, basically, and what they did. And there was a couple of people who I looked up to because they had very nice cars, they had really nice houses, they had vacation homes. And I said, I want to do what they do. They happen to be developers. And so I thought that, okay, I'm going to be a developer. Like that's what I want to do. And they gave me some pretty prudent advice. They said, hey, that's awesome. Like, hell yes. Like we love that you're motivated and want to go do that. It is very hard to have your first thing be development, right? Because there's so much knowledge in there. There's so many things. Like, it's just a very complicated, very risky business. The fact that he was like, I'm going to do development for my first real estate stuff, that to me is a sign of who he was as a person. Of just like, I'm going to go 100% or all or nothing, right?
Yeah. I
Go for
mean,
broke.
you think about what he had gone through, and a lot of Holocaust survivors that were successful in business.
Mm-hmm.
You can see where the mindset came from. Like they faced like the worst, and for them taking risk in business, like it was compared to what they had to go through.
Mm-hmm.
My grandfather was risk on.
Yeah.
And he was comfortable taking that kind of risk, comfortable betting on himself. And he saw a lot of success as a result of that.
Do you know if there were any times, because I've heard a stat here, I think it's like 2 out of 3 developers go bankrupt at some point. Was there a time when he had crossed the threshold of where if a project went bad, he was going to be okay? Because I know a lot of times it's just you're stacking every next one is a risk because you're betting everything that you've made on the previous ones. And so at a certain point, you get over that threshold. Do you know if there was a point in his career where like he had bet 2 decades worth of,
Mhm.
profits on one?
Yeah, it's a great question. I don't know, I know a lot about my grandfather and his
Yeah.
career and story. No one's ever asked me or I've thought about that question. Certainly on his first deal, he had bet everything
Yeah.
and he almost lost everything.
Yeah.
He came out with his integrity, which ultimately was the greatest investment or gift that he got out of that.
Sure.
Talk about how we don't look at our failures as failures, but they're just stepping stones for us,
Yeah.
lessons learned. Like you can take every dip down and turn it into something that can work out for you for the better. And that's a great example of it. My grandfather, over time, like he created for himself some principles around taking risk.
Mm-hmm.
And so he wouldn't necessarily be having multiple projects going on at the same time. He'd buy a piece of land, develop it, sell it out, buy the next piece of land, and kind of go on from there. And then I think as he got more established, he was taking on more risk. I mean, as the story goes, he started getting into multifamily development in the late 60s,
Mm-hmm.
early 70s. Was one of the big builders in West Hollywood and Hollywood. We have legacy assets, legacy buildings in our portfolio in West Hollywood that we built in the early 70s are still in our portfolio today. So ownership for over 50 years in many of these assets. We wouldn't be buying 60, 70, 80 unit buildings today in our current form, but we have them in our portfolio because they're built by my grandfather and we've owned them for a really long time, and they're kind of like they make up the core part of our legacy portfolio.
What are some things? So I read, and I want you to walk me through this because I want to know the truth about it. Again, so you guys had a Koreatown property, right?
Did
And
do.
you do. Was there a property that you lost $7 million on? Did that happen?
uh
Or was there a loser in K-Town that happened?
no. No, we only have one K-Town asset.
Okay.
And
Currently?
yeah,
And you still have it?
and we still have it.
Okay.
We actually are closing the refi today.
Oh, congratulations. Okay.
Literally,
So we
it's
we didn't write
happening
this. We didn't lose. So
No.
what have you guys had losers before?
So we've been buying throughout every single cycle,
Yeah.
right? Call it since 1956.
Yes.
Right. So business is cyclical, real estate cyclical. We're in a real estate recession right now, right?
Yeah.
And so we were buying in, call it 05, 06, 07. Our ability to kind of figure out on how to like save deals
Yeah.
through being properly levered and having the capital. So we bought an office building. This is like, not really a loser, but like not a winner.
Yeah.
But, you'll hear the story. We bought an office building in Orange County in 2008.
Okay.
All right. It was a secondary Orange County office market that at the time was 95% occupied and $250 a foot in rents. Half of the building was subprime tenants. Comes a Great Recession, subprime goes up, occupancy drops to 50%. Building rents drop from $250 a foot to $165. And we have to re-tenant the building, and we've put in major TIs, right?
Oh shit.
And we had a CMBS loan on the property. Thankfully, it was fairly lowly levered at the time. But we spent the next 10 years building the NOI back up. We renovated the whole building. It was one of the reasons that one of our big pivots out of the Great Recession was from a portfolio that was diversified against product types. So we were retail, office, and multi. Actually, 60% of our portfolio was retail and office, only 40% multi heading into 2009.
Jeez.
And we saw our office buildings and some of our retail centers just implode. You have to fill your buildings because you have big vacancies, right? One of the benefits of multifamily is you have a diversified income stream.
Mm-hmm.
You have 100 units, you have 100 different tenants that have 100 different jobs, right? you have a diversified
Uh-huh.
tenant base, right? You have, a 30 tenant office building, right? And you have one tenant that has, a third of the building. They're a major, they go under, you have a tremendous amount of exposure.
Mm.
Now you combine that with a recession, you have to, no tenant comes in for 1 year.
Mm-hmm.
It's a 10-year lease, and you're signing a 10-year lease with 3 5-year options at rental rates that are at all-time lows. You're basically mortgaging the future of the building away,
Yeah. Jeez.
right?
Totally.
And so that experience is what opened our eyes to retail and office is not the business model that we want to focus on. We saw it ourselves. We saw multi drop 10% in rents and rebound within 2 years, and we saw office and retail, between occupancy and rental rates dropping 30-40% and a long way back to build back the NOI, to just get it back to par. And so this office building, we ended up selling it in 2019. We made a modest profit, but it took 10 years. It was a lot of effort and a lot of work. Took a lot of capital, a lot of time, a lot of energy and resources to kind of save that deal. And then we sold it and we bought a massive multifamily project in Washington, in Bothell.
Was that your first out-of-state transaction, or when did you guys start buying out-of-state?
That was, hey, good call. 2018 was our first out-of-state multifamily purchase, and it was that deal. We bought that in 2018.
Okay, walk me through the internal conversation, right? You guys are a California company.
Yep.
And at a certain point, there's internal conversations that, hey, California may not be the place where we want to invest. Walk me through what it's like in that room. What do those conversations look like? What was the thesis? Like, why?
Okay. So it started with a basic investment principle of too many eggs in one basket. The conversations, we first started buying in the Bay Area,
Okay.
right, in 2015.
Okay.
That was our first Bay Area acquisition, which is, a couple 100 miles away, harder to manage and own and operate. We had been watching the success of the Bay Area through the tech revolution. We wanted to play in it. And then it was like, but we still have 95% of our assets in California. That's just too much for us, for our investment, for our investors. And we want to geographically diversify. And it started as a conversation of less about, we don't believe in the future of California, more we want to diversify, right? And so we went to Washington, which is another blue state. Oh, by the way, right? Because at that point in time, we were very focused. Our investment thesis was around what we called JSS, jobs, schools, and supply. And it was, we wanted to be in major job centers. We were very focused on kind of first ring suburban markets, where you weren't in the urban core, but you had awesome jobs in your urban core, but people wanted to live in a first ring city because of the better schools, and they were okay with the commute, and you had a more affordable rent. We started that strategy in 2012 when we bought a bunch of buildings in Ventura County.
Got it.
Right, so we bought 3 deals in Simi Valley. We bought in Moore Park, and we bought in Thousand Oaks. Right, we were playing right. We were playing in that back in 2012 and 13 and 14. And also the last thing was supply. We were very focused on barriers to entry. That was what we had grown up with, a barriers to entry market. And we like the dynamics that come as a result of a barriers to entry market. And so we went to Washington, went to the Bay Area because of jobs. And we went to Washington, Seattle MSA because of jobs. And then we were buying in kind of those first ring districts. And so it kind of started out really around, hey, we should be geographically diversifying, and everybody was on board on that. And then as it got harder to do business in California, and it was getting harder, right? We had rent control, but we knew how to operate within rent control. Rent control has been around in LA since 1979.
Yeah.
Right. And so it had been around for a long time, and we had kind of figured it out. But the regulatory environment started getting harder and harder. And what we came to appreciate after, we dealt with COVID, right? So just so you know, we have 24 buildings and 3,300 units in LA County,
Mm-hmm.
right? So we have a big portfolio here.
Yeah.
COVID was really challenging.
Yeah.
Right? The way that the city just reached into your pocket,
Yeah.
gave you no rent increases for 4 years,
Yeah.
didn't cap insurance, didn't cap property taxes, didn't cap, kept on, payroll from, minimum wage increases that had a trickle down effect or a trickle up effect at your properties. It became really, really challenging, really clear that the barriers to entry story or the benefits of it in a highly regulated environment just encourages more regulation. So as we saw rents grow and the politicians couldn't figure out how to fix it, and the fix is more housing, but who wants to take that position and deal with NIMBYs and deal with traffic and really be thoughtful and multi-year planning,
Yeah.
right? When, politicians' lifespans are really, really short. And so the incentives are in place. And so rent growth turned into a problem. The barriers to entry story then made people say, hey, there should be a ULA tax. We lost the most money in our company's history the day that ULA passed.
Wow.
I mean, 5.5% on gross.
Yeah.
It's wild.
Insane.
It's insane. So we've kind of so then the out-of-state conversation turned more about investing in higher growth markets,
Okay.
red states where affordability was really important, right? The cost of the lack of affordability is becoming a problem for renters. It's becoming a problem for employers. And employers are leaving high-cost states and they're opening up shop in other major MSAs where their residents, where their employees can find affordable apartments. And so we kind of adjusted our investment thesis and we looked at a supply a little bit differently, right? Schools then now became not about great schools to send your kids to, but schools as an economic engine. So we're invested in Phoenix. ASU is a tremendous economic engine.
Yeah.
It's delivering tens of thousands of graduates every single year for the employers there, right? We still wanted, good schools, needed to be a major MSA, so good jobs. And we wanted an affordable rent, as opposed to, where people are paying so much in California as a portion of their income. Markets that had population growth. And it was kind of like we rode this golden years of California. And like California made our company, it made our wealth, it made our family's wealth. We're still here. We live here. I mean, there's not a better place in the world literally to live during all seasons of the year. But everything peaks. And California feels like it's peaked. The growth is happening. If I would try to project or think through, is there going to be more growth in California from today and 10 years from now, or in some of these other markets? I think the growth rate that's capable in California versus the other markets, California pales in comparison to what we're going to see there. And so that's really kind of, how we're thinking about it. Look, we still have 65% of our portfolio in California. As I said, like, we live here. We're not rushing. We've never rushed to do anything, right?
Yeah.
We've been around for 7 decades. I could lay out for you 7 pivots that we've made over the company's history, right? Not every investment thesis is right for every market and for every time. And so we're nimble and we're willing to pivot and not say, hey, we're stuck making this widget at, in this place at all times. And so this is, the pivot that we're in right now, around, hey, California has a lot of structural challenges in it right now. And we're making that bet anyways because of our existing portfolio. And so as we think about growth, we're finding, we've invested in Phoenix and Austin.
Okay.
We're looking at Nashville and Salt Lake City.
Okay.
And we have kind of Dallas on the back burner. really big market to kind of try and learn. But we've had we've had success breaking into new markets, and so we kind of built a playbook around it.
Let me ask you, was there any part of you that saw the success of some of these other companies in 17, 18, 19 who made a shit ton of money in those high growth markets that was like, hey, what are they doing? I want a part of that. Was there any piece of you that was like, hey, I want to, like, were you looking at what other people were doing at a certain point? Was that part of it?
It was more of an internal thought process of where should our growth be? Because everyone has a different formula and a different metric, right?
Yeah.
So I remember we were competing on a deal in Phoenix, and we lost to one of these companies that
Tides?
maybe. I remember getting the deal book kind of sent around, and I was looking at the numbers, and I'm like, oh, like I get how they got that IRR, right?
Yeah.
Like if I couldn't figure out how to get to 16 or 17, but it was taking a level of risk that I wasn't comfortable doing. This group found a capital partner that was willing to take that risk alongside of them.
What were those projections? What were some of the things that you couldn't wrap your arms around? Was it rent growth?
It was the leverage point at 75%.
Okay.
It was a 3-year hold, a very aggressive turnaround around turning units. Looking at post-renovated rents that's on the margin, right? But like those two things of like timing it so perfectly that you hit like this, 15 plus IRR,
Yeah.
the leverage to get you there. I mean, you're talking about a model that has to be perfect. You have to hit on every point.
Mm-hmm.
And no model should be blessed
No.
under a scenario of perfection, because nothing ever works out the way that the model goes, right? So you need room in different areas.
Mm-hmm.
It's just kind of like necessary in order to play for long periods of time.
Yeah.
Like it's
Have you ever looked back at deals you've done and seen how close or how far you were from the actual model? And
yeah. We've done that before. Like, our early value add deals in 2012 and 2013 and 2014, it's fun to see how we, beat the projections. And then as value add kind of got priced down in 2019 and 2020, we actually started to pivot we did our last value add acquisition in 2020. And then we actually switched over to buying more core and core plus assets.
Tell me about that. Why?
Because we were seeing how you weren't getting rewarded for buying vintage and taking on the risk of renovating. So when we went into Phoenix, right? We went to Phoenix, we weren't doing the 60s and 70s and 80s value add. We were buying deals at a lease up, buying quality product in good locations. And those were peak purchases, right?
Yeah.
And they'll take time to season.
Sure.
But we have great product in good parts of town. And there's a supply story that's getting absorbed. We're probably still 12 months out from seeing the bottom of it. But if you were buying 60s and 70s or even 80s vintage assets in Phoenix at 2021 prices, I mean, you're really, really hurting, right? And then you have product that's just really challenging and you have no pricing power right now.
What is your current model? Like, what is the business return metrics? How do you guys look at deals? Are you trying to hit a specific return threshold? Do you have a 10-year hold timeline, right? Or refinance 10-year cycle? What is your actual investment thesis?
Right. So we've just seen in the last 2 to 3 years a real asset value reset, right? And it took, like, you've seen it, right? Transaction volume has completely dropped. There's been a very wide bid-ask spread between buyers and sellers.
Yes.
Rents in many markets, particularly we'll call it outside California markets, Sunbelt markets where there's been a lot of supply, have seen rents come down in Class A, and it's put a lot of pressure on Class B and C as a result of that. And there's also a concession game going on. So the value add game is really tough to pencil right now because you don't really have that rent premium. And if you're asking like what we're looking at today and what's kind of the investment thesis today, we're looking at newer buildings, either brand new coming out of lease up or within the last 10 years. Typically, we're trying to identify capital stack distress,
Okay.
right? So where you might have a developer that's got 7 deals going in a market, they're trying to figure out, which ones to keep, how to hold on to some. They need to create liquidity. There's a lot of conversations going on. And what we're finding as we're, pricing things, our pricing deals and opportunities is that if you can get a deal across the finish line, and you know how hard that is, if you can get your like dragging a seller kicking and screaming across a finish line, because if you don't have to sell today, you don't want to sell today.
Yeah.
You want to hold on for longer. You were finding core and core plus deals that are at returns that are punching above their weight, right? So let's say a core deal is getting to a 12 to a 13, and a core plus deal, call it a 2015 to 2020 deal, is 13 to 15. And that's like an interesting story, right?
Yeah.
And there's a lot of conversations. There's marketed processes that get broken, and then you hang around the hoop and you keep talking with the group, and they're like, hey, we didn't like that pricing, but now it's a couple months later and things aren't better, and maybe we're going to run a mini process, and you've been staying in touch, right? So there's a lot of like ear to the ground, walking the streets, staying in touch, leaning into relationships, and investing the time up front without really knowing if the deal can be made, so that you can be in that spot as a deal can come together.
Why do you think institutional investors lean so heavy into IRR? Why do you think that's the golden metric that everyone cares about?
It's because institutional investors are capital allocators. And as capital allocators, real estate is just one sleeve. And so they need to benchmark their capital allocations across all of their different investments, and they need a metric that is comparable across all of their capital allocations. And so as a result, IRR is something that can be weighted for time, because no two investments are ever at the exact same time. And if they have a 10% allocation to real estate and they're expecting it to deliver a certain return, and they have a separate hedge fund strategy and a private equity strategy, they need to be comparing apples to apples, all of their allocations, and that's how they determine like how much we can allocate to real estate. So from an institutional mindset, they're capital allocators, and that's why they lean so heavily into it. And it's had a significant impact on the business. Like I grew up in the business where we were always looking at IRR, right? And kind of like that point. But our old school investors are cash on cash. They couldn't care about IRR at all.
Totally.
The appreciation will come. It's all about the current yield. It's just a different mindset. And oftentimes you can, like, IRR is time sensitive for money, time sensitive for when the money comes in, and you can play around with that, right? And some investors are getting astute to that. Like if you buy a deal and you like hit on a cash out refi in year 2 that like delivers a lot back, and you've structured the deal kind of like in that way, you kind of juice your IRR because more money came back in earlier. And old school investment is like, well, what was my annualized return? Like, just tell me my return. Like if I got it earlier on, or if I got it from appreciation, and it's not time weighted. And they're just like, we're trying to make good bets, and it's not like beat the system and really kind of time it. So it's like a different, philosophy, and I have exposure to both.
What are some of the tricks or things that people do to manipulate some of those metrics? Because I've heard the Blackstones of the world, and these are the big dogs, right? Like they're a very fee-driven business.
Right.
They're AUM driven. They get a certain amount of fees, and like I've heard people break down the actual returns, and they're promoting 15, 17, 22 in this specific fund, right? But I think a lot of it is manipulation, like you said. What are some of the actual manipulation techniques that these companies do?
Well, I don't know manipulation.
It's
Manipulation,
just
but there are There are ways to kind of juice IRR or juice returns. Leverage being an important component. Like I remember, our philosophy was you don't make capital calls, right? So if you have a renovation plan, we're going to pre-capitalize all of our renovation capital all up front. That is a huge drag on IRR. Right? You start because now you have this capital. It takes you, if it's a big asset, it take you 2 to 3 years to renovate. But our investors, they didn't care in the sense that they weren't looking at IRR, right? They believed in the business plan. They thought that the return on cost for the renovation would work and the appreciation would come, right? But then as we started getting more into IRR and benchmarking ourselves against peers, and really IRR is a metric that we need to be tracking from a valuation standpoint, because I need to understand if I'm competing against, an institutional type of investor, I want to know how they're thinking about it too. And we haven't talked yet about our vision now on diversifying our capital sources. And, now we're starting to talk to institutional capital about investing with us, alongside us in our investment thesis. But those first deals on the value add side, we capitalized all of the renovation capital up front. And then it dawned on me, well, what if I can get my lender to fund a portion of this capital, right? And so we would go pari passu, right? So let's say they give me 65% leverage. Instead of me taking 65% leverage up front, and then I have 35% of equity, and now I'm investing, if it's a big value add, it could be another 5 to 6% of the cap stack.
Yeah.
What if I split that 65-35 with my lender, right? And I get a renovation future funding. And then I'm still saying leverage is one of our big principles in investing is watch your leverage, right? And that's came from my grandfather. I haven't had a chance to talk a lot about my uncle and his mentorship of me. And we've worked together now for 16 years. But how we lever our portfolio is the secret sauce to being around for 7 decades. It's critical to not try and chase that higher yield because you got a little bit more leverage. And balance your risk. A risk-adjusted return is a great thing, and it's a real thing. And you're really seeing it in today's market. The difference between being able to hold on to a building now and not is how are you levering your deals? If you were levering your deals between 55 and 60%, you might have some equity impairment, and you'll definitely be able to kind of work your way through with your lender. But if you were at 70%, in some of these markets,
you're feeling
good luck. It's tough. You're really feeling it.
So why did you guys, let's talk about that transition from going to more private capital to institutional. Why that change? Why are you looking in that direction?
Yeah. So, after having done this now for 7 decades, and our platform we've really kind of institutionalized. That shift from 2009 to today, I talked about our portfolio allocation. We were 60% retail and office. We also were 2,500 units. And today we're 10,000.
Oh, wow.
Right? So talk about how the platform has been able to grow and invest in people and build out a team, right? And our ability to transact and execute on business plans with the team that we've built is now fantastic and stellar, right? And so now it used to be about, hey, we're the Nagel family. We're a real estate family office, come invest alongside of us, right? And now it's hey, we have a skill, an expertise, and a talent, right? And I want to leverage my skill and expertise and talent to buy more deals. And I'm still investing alongside it, but I'm not taking 30, 40, and 50% of the deal because I'm doing more, right? I'm coming in truly as a GP. And look, we're operating in California, Washington, and Arizona. Imagine this, right? We have, let's say we have a track record, not let's say, we do. We have a track record on buying vintage deals and renovating them. We've now established a flagship in each one of these markets. And we're running, management teams there, right? And using Arizona as a portfolio, as an example, I have a pretty core portfolio there, a lot of kind of newer builds. When value add comes back, I know exactly where rents are, right? And if you know where Class A rents are and you're operating it, I can start picking off buildings, right? And my market knowledge allows me to be like, hey, I know where the Class A rents are. I'm operating here. This 80s deal next door, right? I know exactly what the delta is. I can capture that 200, right? And there's a real story there on how we can execute given our expertise and be able to kind of run through a business plan and kind of sell.
Do you feel like that ability is allowed you to go and look at different markets too? Or is that how you're looking at where new opportunities are going to be? Is you want to go and build this kind of like hub and spoke? So you want to get the newer product, right? And then have that ability to then understand with the data where you can go and pick and choose, like you said. Is that the new thesis for that?
Yeah, well, absolutely. The investment opportunity today is in Class A,
Okay.
right? That's where it is, right? But the follow on, right? I'm already thinking like, where does this go, right? We need 1,000 units in a market in order to operate there. Otherwise, it's not efficient for us from a management standpoint, right? And it's a great story around being vertically integrated, right? It doesn't have to be, right? We have a great asset management team as well, right? But when you're operating it, it gives you even more eyes and ears on the ground. And so building up this portfolio in a market that I think is going to, be a growth engine, right? Austin's rents have fallen. Now's the time to buy. We're calling it buy the dip, right? Austin rents have fallen not because people make less money. It's because there's more supply than demand. But that imbalance is not forever. It's going to get absorbed. There are much fewer deals that are being started right now. I'm sure you've read and heard, right?
Yeah.
It's a real thing. Like the supply across the country, the supply cliff. New starts are down tremendously, and so the opportunity is in buying the dip on these Class A deals. And then you're riding a rent recovery, but not a rent growth story. It's really recovering to where things have been and deals are kind of penciling that if all you're getting is kind of that and maybe a smidge more, you're still putting together really interesting returns, right? And then value add is going to come back. We need the delta between A and B and, A minus and B minus to kind of grow. And then value add will come back and we'll be in position to.
Do you, because a lot of the people and investors I talk to, there's pros and cons with going institutional, right? Because at a certain point, the institutions start to run a lot of the decisions, and it can be a loss of control. From what people have told me is it feels like I'm not really in charge. Like, hey, we can get through this tough time. I understand the plan. Like, we need to hold on for a little bit, but the capital partner says we need our money back. We need it now. Like, you got to get us our money. We can't afford to have another 12 to 16 months for you to stabilize this deal and make it work. At least that's what I've seen Ties and some of the other people too. Does that fear ever cross your mind, or have you weighed that?
Oh, absolutely. At its core, this is a relationship business.
Yeah.
And we've always been about our relationships, our lender relationships, our investor relationships, our broker relationships. We value tremendously. We invest in our relationships because they matter. And the worst kind of problem that you can have, quote my uncle, is a partner problem. So pick your partner wisely. There's a lot of capital out there, but just because you have money doesn't mean that we're interested in taking it. And so I think that philosophy follows into the institutional space. Who you're taking money from. People have reputations. Institutions have reputations. And so that gets weighed and that gets factored, right? Who do you want to do business with? What is that? What are the values? Are our values aligned? We've been when you talk about control, look, if someone's giving you 90% of the money, they're going to have not just a seat at the table, right?
Yeah.
But you want that relationship to be there. It's really, really critical. And for us, we're fortunate, we've built this private capital, investment profile. We have this portfolio already. Currently, right now, we have, a good engine like we're from where I'm standing, I'm like standing on Mount Everest and looking to grow more.
Yeah.
Like I'm super blessed and
Yeah.
so fortunate, to be where I am, to now look at the next growth and like, this is like, Decron 3.0,
Mm-hmm.
right? We've had a bunch of iterations, constantly pivoting. The family's been set up for success. We've done well with our investors. We've built, this great portfolio. It is going to be different. If we do go down this path, or when we do go back down this path, we will be giving control because they're giving 90% of the money.
Mm-hmm.
But that's the deal,
Yeah.
right? Like that's kind of the partnership, and we're replacing, we're making more investments across, different, either partners or properties or business plans. So it's being accelerated,
Mm-hmm.
and allows our reach to kind of grow. And it's all based on the fact that we've, built a team that can execute.
What do those markets have that LA doesn't?
So the challenge with LA and my concern about LA, and I hope you asked me the question, like, what would it take for you to buy back in LA? But the challenge is that expense growth is exceeding rent growth. And that's just a hard nut to crack.
Mm.
Between insurance, between payroll. The only thing that's steady is property taxes.
Yeah.
Utility costs, repair and maintenance. The way that AQMD forces us to deal with repair items in older buildings in LA today versus just 5 or 6 years ago, a small plumbing leak used to be really easy and quick to patch, and the regulation is very challenging around that. And it's just driving up costs in every single line item. And so, and rents have not grown that much. It's
No.
been pretty anemic. I mean,
Yeah.
we see it kind of all over the place.
It's been flat
So-
the last 2 years.
So it's challenging when your expenses are going up and rents are not going up. Now, here's the kicker, right? Or this is really like where the concern comes in. In a barriers to entry market like LA, you would think that, well, rents are going to go up because there's just not enough supply for demand. Well, there's two concerns around that. Number one is population growth.
Mm-hmm.
Are we growing?
No.
We're not.
Yeah.
We're losing people, right? And so that's a challenge. The markets that we're going to have people moving in by tons. People want to be living there, right? When we saw our success in California, it was when California was the golden state that led the country in population growth every single year.
Mm.
That's not the case anymore.
Mm.
The second thing is, let's say you do get that rent growth. California, I'm worried, is going to follow in the ways of New York and how the New York is handling rent control.
Mm.
And it just eviscerated values there.
Mm-hmm.
And the success of owners and developers is seen as a problem, right? If developers and owners can be successful, they'll be incentivized and interested to build more units. And if you build more units, you will bring rents down, and then you will once again be a growing state with a growing population. It's being proven out across the country that the biggest solution to high rents is supply. And I mentioned this a little bit earlier, but I'm just, if the barriers to entry and the supply constraint is putting enormous pressure on politicians to do things that they aren't Band-Aids, they're actually making the wound worse.
Yeah.
And so that's kind of the concern. Now, the flip side is like, we're in California, we're in LA, like we've been investing here for decades.
Mm-hmm.
Like we look at all the deals that are here that make sense for our buy box, certain size, et cetera. Basis is a real thing. But I can get basis in other markets. For LA, I want basis and yield. That's the key. Basis and yield, newer product.
So is that what it's going to take to get you back in LA?
Yeah.
And so where how far off are you guys on the deals that you've seen in the last 12 months, right? Like how far off have you been?
Well, some of these cap rates that deals are trading at are they're great basis. Like you can't,
Yeah.
replicate, that deal, but between concessions and vacancy, they're not good cap rates. They're not good going in cap rates. And that's not enough to counteract the concerns on the risk side that I've kind of shared. If I can buy a deal that has, at today's financing, can deliver a good yield, and I'm a believer that that's going to come down over time. Like
Yeah.
we're not. This is not a permanent shift. It's taking much longer than we anticipated. But if you can make money at today's interest rates and get a good current yield, then as I'm waiting for appreciation, I'm good.
Got it.
Right? And if appreciation doesn't miraculously come, but interest rates come down, then I'm even at a better yield, right? That's also good. So it's risk mitigation, the yield and basis requirements.
Give me an example of a yield that would get you like, okay, let's do this in LA specifically.
5%.
5%.
Yeah. So a real, a real cap rate that's north of 5.25.
And what does a real cap rate mean?
Real, year one. Year one, like give me your rent roll today and tell me what concessions you're offering when people walk into the leasing office, and I want actual expenses, and I'll roll that forward for a year. Am I at a 5.25?
Do you think brokers because broker math is a real thing, all right? Obviously. Why do you think brokers price the deals the way that we do?
Am I talking to a broker?
Yeah, no. Talk. You can talk. This is an open community. Like, be open. Kimono. I want to understand, why do you think that's the case? It's blanket really across the industry, right? If someone's going to do it, and we, the thing is, you get rewarded for what you do, right? And I've seen enough transactions where you're like, who the hell bought that, right? And the numbers were baked out of a million things, and you're like, that's not really the numbers it is, but it sold, so I bought it.
Yeah.
Right.
Look, at the end of the day, you only need one buyer.
Yeah.
Right. And we've been sellers, right? And you see this all the time.
Yeah.
You see bid sheets, right?
For sure.
You sell it to the outlier if the outlier is good enough.
Yeah.
And then supposedly that sets the market. But is that really the market, or is that the outlier?
The outlier.
Right? So I think that's why brokers do it, because sometimes you can actually get an outlier. But the business has really kind of changed. And I've seen it become even more democratized. Like I came into business in 2009. Like Google Maps was barely being used in 2009. Like you to see a deal, you actually have to go and drive it.
Yeah.
Right. You couldn't do desktop.
Do you have a TomTom? Do you have one of those?
I love that.
Yeah.
TomTom,
Yeah.
Right? And so there's so much like knowledge and information that's out there. There used to be a real big imbalance between buyers and sellers about how to run a deal, and like that's kind of like the old school way, right? Now it's like, there's so much more sophistication that goes into winning a deal around, well, what's the business plan? How are you structuring this? What's your financing? How do you really understand like the nitty gritties of this market that you can, identify a little bit of a niche? Because otherwise, everybody you can go to any third-party manager and they'll give you they'll give you a pro forma and tell you exactly what's going to cost to run the deal. They expect you to hire them, and you expect them to deliver on that, on those expenses on day one. Otherwise, they're out, and that's a bad business model, right?
Yeah.
So there's just so much more information out there. The ability to like hoodwink a buyer in today's market, certainly on larger size deal where we kind of play, it's much harder, right? But outlier buyers exist. Buyers' motivations vary around their needs. Seller motivations vary, right? And so that's kind of like the art of the game, right? Understanding, buyers' motivations or sellers' motivations.
So how do you create the edge, right? If everyone kind of has the same information, how do you get an actual deal that has alpha? That's my favorite word, alpha. How do you find a deal that actually has that opportunity, when everyone else is seeing it. And like, if you're a good broker, right, and the owner doesn't want to sell off market, everyone's going to see the deal pretty much, right?
Right.
So how do you win?
Yeah. Um, a number of ways, right? And so harder on fully marketed deals, but it's a combination of structure and execution, right? So you can create alpha on thinking through, like, how are you structuring this deal? How are you capitalizing it? How are you financing it? Execution side, it matters. Like, what's your cost structure on
Hmm.
construction? How knowledgeable are you on where this building sits within a market? As we've broken into new markets, we've created like proprietary maps that we use, that every single time we go to that market, we're logging parts of town: green, red, yellow, light blue, kind of like Green Street,
Uh-huh.
type of colors,
Uh-huh.
right? I can tell you how many deals we've underwritten in Phoenix. Every single deal we've underwritten, it's on my map. I can tell you every single deal that we did a rent comp survey on, right? And so I can say, like, oh, we've looked at 155 deals in Phoenix right now. We've underwritten it, right?
Wow.
And I know the location of all of it. Now, new deal pops up, right? I looked at this deal and this deal right around the corner. I didn't like that side of the street. That side of the street was the wrong side of the street, right? And so you press, this building is special location. I saw this deal being built, right? And you start building like kind of street by street, block by block
Uh-huh.
knowledge. Um, and and what's empowering, and what, now coming back to building a team, right? Is you create this process, and then your team is doing it, right? And that's how you're able to leverage. That's how you leverage being in more than one market at a time, because you've created a process, you invested in your team, you empower them, and then good things happen.
Let's talk about technology, because we talked about this beforehand, and I'm big into it. We recently started this like AI CRE community, which has been awesome to be
Yeah,
a part of, because so many people realize that technology is really going to change
right.
not just real estate and investments, but like the whole world. So how are you looking at technology? How are you guys implementing it right now? Do you feel like you're doing a good job? Um, as a CIO, right? You got to think about how you can get the best edge. Like, how are you guys using technology and looking in the future for it?
Okay, great question. Can I tell my story now?
Please.
Okay, I'm parked in the parking lot out here, and I'm on a call with um, a freshie. Guy's 30 days in the industry. Okay, he's working at a debt shop.
Good for him for calling you.
And he pestered me, and and he apologized, and he said, "You know what? I appreciate your persistence." We had a great conversation, and I took the approach of trying to like mentor him, right? And so I said to him things like, "Money doesn't matter right now. Find the person that's going to train you and spend time with you. I don't care about title. Be in the room where it happens. Be a fly on the wall." Like, the biggest benefit that I had in my career when I started in 2009 was my uncle just let me sit in the room with him and my grandfather. By the way, I got to work with my grandfather for 9 years,
Yeah, wow.
which was incredible. But I got to be a fly on the wall. I
Yeah.
got to just observe and learn and absorb, and that's what I told him. The second thing that I told him was, "You're young. You get technology. You should be using AI to make yourself more efficient, because I promise you, your boss, who's 15, 20 years your senior, he's not sure how to use it. And when you tell him that you took a process that used to take 10 hours and now takes 2, and then you go and write it up as an SOP, and then you say, hey, I can actually teach this to the other 3 people on my team, you're making yourself invaluable.
Hmm.
So go spend time and figure out how you can use AI to make yourself more efficient."
Hmm.
And at that point, he says, "Oh, do you know Taylor Avakian?"
No way.
Talk about synchronicity. I was parked in your parking lot talking to this guy,
Let's.
and he said, "Do you know Taylor Avakian?" And at that point in time, this was at like 10:07,
Yeah.
you parked your Tesla
Uh-huh.
right in front of me, and you were walking out of your car, and I was like, "This is insane." I am looking at Taylor Avakian right now. You just mentioned his name.
Whoa.
And,
Whoa.
I was going to ask you like who your audience is, but people are listening.
Yeah.
And they love what you're doing.
Thank you.
And so the reason why he mentioned your name was because he's like, well, what you're saying, no one said that to me, but I've been hearing this, and Taylor's really into this.
Okay.
And he'd heard he's listened to a few of your podcasts. And,
okay. So he sees what's happening.
He sees what's happening. And so I was saying to him, like, spend time, right? You can figure this out. Things should be taking much, much shorter. And so you asked me like what we're doing or what I'm doing, and we're still dabbling and figuring it out.
Yeah.
But it is super powerful. I mean, we have, people have different skill sets, right? And so let's say, you're good at math and you're good at modeling, right? But your English isn't great, or your writing skills aren't great, right? You have to put together a memo, an investment memo. I don't want you spending your time figuring out the English language and how to put this together. It's a waste of your time. Please use AI to help write that memo. It will get you 95%, probably 100, right? Please check your work.
Yeah.
Please read it over. I don't want my name misspelled in there,
Yeah.
Yeah. So that's always the risk, right? Like,
Totally.
Like you put it in the hands and all of a sudden it's like, a cop out.
Yeah.
But if people understand that this is something that can make me more efficient,
tool.
but it is not my final product, super powerful.
100%.
And I'm just like accelerating what I can do. I mean, I don't write emails, right?
Yeah.
Memos, like I dictate them into AI and review it.
Yeah.
And like I just get to things faster. I'm able to distribute things faster. And so I played around for a while with read.ai as like a note taker on my calls, like, with follow-up lists. And so it's experimenting right now. But my eyes are open. It is really interesting. I'm encouraging my team, to use it to make themselves more efficient. Look, we have to become more efficient, and do more with less. Real estate's in a lean time right now, right? And so, you got to figure out ways on how to become more efficient, and AI absolutely is going to get us there.
Where do you see it helping from the actual investment and business side of, like, are there things where you're like, okay, if it could do this, or when it can do this, I see it really changing the way that this industry is going, or how it works?
Are you talking like big structural things, or you're talking like how we do what we do?
How do you get an edge? Like how, because the reason I'm saying, what came to mind for me, and again, you can take this to whatever direction you think, but you're looking in these different markets, right? You need to do research. You need to understand block by block, street by street. It's all data. And so if you can take data and basically structure and crunch the research or whatever it takes for you to do that, instead of you having to go to the place 7 times and drive every street, right? Which maybe you do once, you drive every street and you have a video camera and it records everything, but then you have the actual data of the market, where the rent growth is. You have placers so you can see where people go, right? You're taking the data and figuring out for your investment thesis, what market or what street or what pocket of a city makes sense for you. And that's going to change potentially where you invest in. Like, are there things like that from an actual tactical perspective?
Well, I said to you, like, Dallas is on the list, but that's a monster, right? So there's a maximum, it feels like right now there's like a maximum capacity of markets that I can play with given my current, investment team structure, right? And so the ability to have access to and process data quicker and more efficiently I can see it allowing us to participate and become knowledgeable in more markets with less, right? So we could be more dangerous and more knowledgeable and not have to, grow the team and really expend a lot of, human resources in order to do what I previously had to do. Now, it's not going to take, real estate is brick and mortar. Like, it just is, right? And location matters and feel matters. And nothing is going to take the place of of showing up and walking the streets. That still has to happen.
Mm-hmm.
But there's a lot that can be done in utilizing data, and like, where are we going to kind of like direct our energies and our resources?
Mm-hmm.
When you have, the data in front of you, you can make quicker decisions.
I have a couple rapid fire questions before we wrap up. You ready?
Go for it.
Someone gives you $100 million to deploy in 12 months. Where does it go and why?
100 million in 12 months. I would be buying core deals in growth markets, betting on that have strong employment stories,
Uh-huh.
um, at 30 to 40% below replacement costs. I believe in these employment nodes, these secondary coming into primary, and you can buy at such a discount to replacement cost. You will not have a good return. You will not have yield for 1 to 2 years, but I believe in that rent recovery and rent rebound. Those are the markets that are growing.
Give me 3 cities.
We're going to do Austin, Salt Lake City. I still believe in Phoenix.
Okay. All right.
Buy
All
the
right.
dip.
You heard it first. You heard it
Buy
first.
the dip.
What hot market is everyone chasing that you're avoiding?
Mm. What market is hot?
Well,
I mean, I just
from the internal conversations
huh?
from the people you're speaking to, right? Where's somewhere where you're like, I don't want to touch that.
Yeah. Denver.
Mm.
Denver. I'm not saying that it's hot, but Denver is not growing and it's becoming bluer. It was a darling for a good amount of time, but it doesn't. It was attracting employment, but it's petering down.
Interesting. Yeah, it's gonna be interesting to watch Denver. I know a lot of people who went there, and I had some friends who moved there and then moved away. So I'm interested to see what happens in Denver too. What is one metric to track across an entire portfolio? Like what, and then why?
In today's market, in today's environment,
Yeah.
debt yield. Debt yield, NOI divided by loan amount.
Uh-huh.
Given the high interest rate environment that we're in, right? If you're a long-term holder of assets, right, and your debt is rolling off, the metrics around coming off of 3.5% debt and going into 5 to 5.5% in markets where you haven't seen a lot of NOI growth,
Uh-huh.
right? And it's really like it's kind of like if you were in the Sunbelt markets, right? You saw rents really grow and now rents are down, right? And if you're in the highly regulatory environments, you had COVID that basically put a freeze on rents, right? So there just hasn't been like a ton of NOI growth in a lot of different parts of the country.
Mm-hmm.
And so be looking at your debt yields and make sure that you understand what your refi risk is, and be able to manage through that.
Tell me about leadership and your new roles.
Yeah. I kind of grew up in a very different company than we're in right now. So we were much smaller. We had 2,500 units on the multi side, and we had over 3.5 million square feet of retail and office. But retail and office is not a big employee count,
Mm-hmm.
right? Because you really kind of manage it.
Yeah.
From the corporate office, it's a lot of leasing activity, which is just like we now are a company of 310 employees. And the size of operation has really kind of grown.
Uh-huh.
And what's been really so rewarding is being able to be part of a company, building a culture amongst, the employees,
Mm-hmm.
making it rewarding for them
Mm-hmm.
to work and thinking through, like, how do I grow them? How do
Yeah.
I get them to their next spot? Decron's had an internship program for the longest time. It started in the year 2000.
Wow.
It actually started, there was my uncle likes to say it started in the 90s. He had an intern. But in 2000, from 2000 to 2025, we've had 48 interns.
Wow.
Summer interns. It started out as high school,
Uh-huh.
and then it turned into now we really do college. And we actually had our first graduate student, business school student intern this past summer.
Epic.
And when we started this internship program, we weren't ever big enough to offer an intern a full-time position.
Yeah.
And so we've grown to the point where we have entry-level positions. So that's really fun. We hired for the first time an intern who had been a summer intern for us into a full-time position.
Wow.
Really, really exciting. And then you get to start thinking through, like, how do you grow people?
Mhm.
How do you take someone from an analyst to an associate? How do you take them from an associate to a manager? How do you coach them up? How do you think about their career?
Mhm.
And how do you manage people to get the best out of them? Because as you scale and you get big, you can't do everything.
Mm-mm.
You just physically can't. You're not
Yeah.
doing right by your investors, and you're not doing right by yourself. You're not doing right by your team.
Mhm.
And so it's been a really, rewarding and fun part to, be a mentor, think through leadership, think through how to grow our employees to take them to the next step in their career. And if I can't grow an employee anymore
Yeah.
and they can find the next position out of this company, I'm their champion.
Yeah.
I am their champion,
Yeah.
and that feels awesome. That I was able to grow them, so that they could then identify another company that thought they had a skill set that would work for them.
They learn from you.
Awesome. Just awesome. And it's like I'm a deal guy. I love the art of the deal, right? But I'm also a relationship guy,
Yeah.
right? So
Yeah.
deals get done on relationships, and this is a part of relationships which I never really thought I would enjoy and like. And over the last couple of years, as our team has grown and become more a leader in our company and becoming an executive, it's been a really fun part of it. And mentorship is really rewarding. And I would encourage anybody that's in a position to be a mentor to really take it on.
How do you become a better leader? Like, what are you doing? Are you reading a bunch of books? Are you going to, you got a coach? Like, how do you improve leadership skills?
Yeah, I think it's a combination of books, but really it's identifying, right? If you're someone that's junior in the business,
Yeah.
right?
Yeah.
You can look around and see how you're being treated and who is being your champion and who's figuring out how to grow you.
Mm-hmm.
I was in Sun Valley at a mortgage banking conference in the summer, and I heard from Steve Kerr. Steve Kerr talked about his basketball career and talked about his coaching, and he told the story that when he got into the league, he played for the Magic, and he was there for 5 seasons, and it wasn't working out. They weren't appreciating his skill set, and he thought he was actually out. He went around and he said, you know what? Who has my skill set around this league and is being successful, and that team values that skill set? And he identified the Chicago Bulls. John Paxson is the guy. He's being successful for the Bulls. I have his skill set. I can do that. Calls up the Bulls and says, I want to work out for you. He went and made the call to the Bulls. I want to work out for you. He works out for them. They like him. Joins the team. Jordan retires. Now there's 43 more minutes available for him to play on. And suddenly he gets playing time in Jordan's absence. He actually starts to make a mark. And then the rest is history.
Wow.
In that he then helped facilitate the next 3 championships
Wow.
with Jordan. And he tells all of his younger players that join the team and says, find the person in the league that has your skill set and go copy them.
Mm-hmm.
Go study them, study their moves. So when you're in the business and junior and someone's out there making you feel good, supporting you, leading you, has your back, that can be your leadership mentor. You know it for yourself.
Yeah.
Find your person,
Yeah.
right?
Yeah.
And talk to him, because you can't just read it in a book.
Yeah.
You have to see it practice. You don't know how to have those conversations until someone's had them with you. And you're like, oh, that's how it feels to be mentored. That's how you support somebody. And you have to go. So everybody has that. Hopefully everybody kind of has that.
Uh-huh.
When that kind of person touches you, they're thinking about you.
Yeah.
You know it, and they'll be open and willing to kind of share and be there for you.
There's this feeling of giving back, and there's a bigger broker who's kind of, we have some conversations now and again, and we do some walk and talks, and he, to me, feels more like a mentor figure to me. And he's like, hey, I asked him one day, I'm like, why are you doing this? He's like, someone did this for me, right? And I expect you, when you get to where I'm at, for you to do the same, right? It's like this passing down of the guard. And it honestly, it feels fucking good. It feels really good
Mm-hmm.
when you can share and help someone move forward in whatever goals they have.
Yep.
I think it's really fulfilling to be a part of that. And I agree with you, but it does, one point you made about Steve Kerr is he reached out and he actually did something with it. You have to be willing to not wait for things to come to you.
Yeah.
You have to go and grab it. You have
Yep.
to be that person who is like persistently annoying, but not annoying to a fault where it negates you, but also you understand the EQ of what it takes and what that person wants, gives them value, because it is very hard in this world. And you've known it. There's not a lot of A players. Like there's a lot of good players. They're
Yep.
good at what their job, but an A player is very rare.
Mm-hmm.
And so if you have the ability to go and help someone who is that A player because they have so many things that are going on, that is a rare quality for them to make their life easier. How
Yep.
can you make that person's life easier? So I encourage everyone and anyone to go and try to find and search that out. And it's not easy. Like you can't just go on one day and find your person.
Yeah.
This is a time, you got to put in the effort, you got to put in the time just as much as you're putting effort into learning your skill at a job.
Mm-hmm.
You have to do the same thing for every other avenue of the business.
1,000%. You got to manifest your destiny. You got to
Yep.
put forth the effort. You have to have the EQ, right? If you don't have the initial relationship and you're just being persistent, bordering on annoying, it's not going to work,
No.
right? And that's why I kind of said, like, find that person that's kind of like already kind of doing it for you,
Mhm.
right? And then, get closer to him.
Daniel, this was awesome. Thank you very much, man. This was
Enjoy the conversation.
Yeah, this was so cool. I hope there was a lot of institutional knowledge, and I love getting in rooms with people who are smarter than me and who look at opportunities differently. And I think I've seen throughputs and lines of what really makes a successful company successful. And the fact that you guys have been around for 70 years, like that is something to be studied. So I really appreciate you coming here and sharing that. And I hope people, where can they come and check you guys out? Or is there any place for you guys, brokers, if they want to sell you deals?
Yeah, absolutely. I mean, email is the best way to reach me, daniel.nagel@decron.com. Check out our website, decron.com. And it was a pleasure. Thank you for inviting me. It was worth the trip to the Valley.
I love it. I know. Thanks for coming out here. Thanks for coming out here, Daniel. Appreciate it.
Good stuff.